All right, what's up, everybody? Can you guys hear me? Is my mic working again? Sorry, sorry about that earlier. How many people we got in here? 6 people. 6 people. All right, that's good. We got some people coming in. Understand we're on the later side. Can go ahead and send a little reminder here. Good stuff. Good to see you, Maxie. Yeah, let me just like push a reminder. How'd everybody's trading day go yesterday? Those of y'all that are in here. Y'all have a good Friday. Ah, bro, no. No. Yes, you need to do this. I mean, not financial advice, right? But like, it's so different. It is literally so different. It's so different for a number of reasons, right? So, for two reasons that I've found. Okay, so one of them, right? One of them is the obvious part that like this is probabilistic. Like covered calls are like in terms of the probabilities, they're in your favor. Just purely, right? So you have to think about like how probabilities work. Like probability theory and the mathematics of it are like probability is how to find how to find patterns in apparent chaos uh, when you don't have specific knowledge. So you have theoretical probabilities that will help you achieve over time specific results with uncertain knowledge, right? So you don't have specific knowledge of individuals. So just based on that, just based on pure unknowns, the covered calls are probabilistically in your favor versus, I mean, a short call, not necessarily a covered call, but a short call is in your favor. A covered call, especially if you are choosing a strike price that is above the cost basis you paid for the shares or the contracts, right, that you are using in order to hedge that short call position. It's super hard. Like that's even more if you're just like controlling not even a win rate on the trade. You're calculating the profitability of that trade. Like it, yeah, that's way in your favor. Okay, so you have that just kind of in the structure with no specific knowledge. Another two things that I've realized is one, if you like, you can way boost your probability. You can way boost your win rate on like riskier things that like shouldn't be that high of a win, like like selling a $30 like weekly call when the price is at $29.50, like should usually not work out for you, right? In terms of the profit, that should be like a coin flip based on the probabilities of that expiring out of the money on that given week. But it's not a coin flip, right? And we've seen that over the past few years. It's not. It's way not a coin flip, and part of that is indicated by the gamma exposure data that I talk about on a regular basis. If you know where a call wall is, this is why I say not just selling covered calls. Call wall targeted covered calls are a really, really high probability trade because number one, the structure, roughly, the rough structure of the dealer's book. And so how they're going to hedge that position to account for movements in the price that could jeopardize the profitability of their option strategy. That's number one. And number two, we also know that the market is rigged. And this is another thing that was really big for me to really find specific evidence of, at least for myself, right? I mean, would any of this hold up in a court of law? Probably not. Not a high enough standard of evidence, but high enough of a standard of evidence for me to trade on, based on everything else I've seen. Like, yeah, definitely a high enough standard. So we know then that the market is rigged and that institutions, market makers, broker dealers will manipulate the market in small ways, right? I mean, some of them do it in larger ways, but on a regular basis, they will do this in meaningful ways. So like a very common thing that I've seen happen a lot is number one, I've talked about tactical shorting, but it's a combination of tactical shorting with strategic fails to deliver, and then strategic order flow rerouting, right? Not egregious order flow rerouting, but enough so that on some of those low days, they can ensure that stuff doesn't kind of start to drift up, because that is kind of general sentiment on GameStop. As soon as you let it kind of drift up, then people start to get excited, and you can have a spontaneous kind of upward volatility event occur that you as a dealer can lose control of. It won't fit into your pattern of cycles and stuff, which we're going to talk about today. So because that, right, that they can manipulate, and that they do regularly manipulate the price frequently in favor of their market making strategies, that boosts the probability even more. So basically, my running theory about why covered calls, specifically on GameStop because of its particular structure, are such an advantage trade is that not only is it in terms of the base probabilities in your favor, but market makers manipulate the trading landscape such that the trade is even more in favor of a win of profitability, given the degree to which they control the outcome, right? So I'm pretty sure that's specifically with call wall targeted covered calls. That's why, for example, like over the past year, I've had I should not have that kind of win rate. Like that should not be how that works if you're just going off of the pure like Black-Scholes model probabilities. It should be way lower. I shouldn't have that degree of profitability as I understand it. So just to kind of point that out as a starting bit here. Yeah, so we got a good group here. I understand we're kind of later, so Euro crowd doesn't have the chance to kind of pop in here. We'll try and do this. We'll try and do this earlier next week. See if we can do it on Saturday maybe, but a little bit earlier. So Euro crowd can pop in, and East Coast US crowd can kind of pop in kind of mid-afternoon. I don't know what y'all do with your Saturdays, but try and do something like that just so we don't lose the Euro crowd access to some live participation there. So yeah, very good. Good to see you too, my friend. Cheers. Thanks, man. Yeah. Like, there's, I started doing this. Right. Basically full time. Like this is basically what I do. Like I try to understand what's going on, maybe not with all of my time, but quite a lot of time during the week. I spend a lot of hours on this, and trading is the primary way that I support myself, and have been for the past 9 months, a little more than 9 months, maybe. Yeah, I just, right. Y'all know my background is as an academic, right? I trained as a historian and a humanities scholar, teacher, all that stuff, right? Had thousands of hours of teaching experience. Loved it. Absolutely love that line of work. Absolutely love teaching. Absolutely love talking to people and telling people things that matter to them. I value that a lot, right? my fiance gets a little tired sometimes when I try to, I have been known to spontaneously go into history deep dives, for 45 minutes over breakfast, which can be exhausting. So I try not to let that out of the bag too much. But yeah, man, 3 years I was on the job market, trying to pick stuff up, and basically every time, basically, like, despite my credentials, despite my experience, despite the fact that I have great reviews from students and all that, like, nobody was willing to give me anything more than a non-benefited part-time work for like a couple $100 a week. And you know at a certain point, at the same time, right, understanding what I understand, I think we talked about this a little bit last week, but you know uh, once you're given the knowledge that like the financial system is a lie, right, and that inflation data is a lie by the government, definitely go check this out on Shadow Stats if you have a chance. Inflation, like whenever CPI comes out and it's like, oh, inflation is 2.7%, it's like, no, it isn't. No, it isn't. It's like 7. That's why mortgage rates are like in the sevens. Why would mortgages still be in the sevens if stuff is still down, if inflation is really down in the 2%? Like, why isn't the government lowering the interest rate anymore? If inflation is like within a couple tenths of their 2% target, that doesn't make any sense. And if you go back, right, definitely, we can actually look this up, right? Let's talk about this before we get into volatility cycle stuff today. So great website here. I actually ran this little, like I said, I think last week I started working on a little write-up about this. Haven't finished it up. Shadow Stats here is really great. Okay, Shadow Stats. Actually, not this chart, but their second one is the most telling here. This one. Okay, so let's see if I can make this a little bigger. Okay, so Shadow Stats has been calculating inflation data as though the standards that were used in the US in order to calculate actual inflation up to 1980 were used over the past several years. So what you're seeing there is the bottom line is what published inflation has actually been. Okay, so red line is what the Fed has said inflation is for, or has been in the US. This is up to 2023. So up to June 2023. So it's not all there, but you can see it, right? And the blue line is if you took all of the same data that were used in order to calculate inflation up to 1980, and you calculated inflation instead. So why would inflation data change, right? Why would the federal government all of a sudden basically start reporting things differently? Okay, what's going on here, and at the same time, right, what are the implications of this? So obviously, you can see that it's a little bit higher in the 80s. It's not that much. Like we're talking like tenths of a percent. So it's not that much. In fact, I ran the numbers basically here, right? So between 1983 and what would this be? About 1990, the total compound inflation difference is only about 10 to 12%. So like at first, when they started doing this, the numbers only differed a little bit. It wasn't crazy. But after this, they started to diverge. So right, this is Reagan presidency. After 1990, they started to diverge maybe by about a percent and a little bit. But then stuff really started to take off during the Clinton, Bush, and then Obama. Actually, the Obama years, they stabilized a little bit. Clinton and Bush were crazy. So every single year, the gap actually widened on inflation, right? So this is where you get like throughout this period, the government is saying through this entire time from 1993 all the way to 2008, what the US government was saying, which, right, keep this in mind, the US dollar and the US economic system are the basis for the global financial system. Okay? What the US says, because the US is essentially the guarantor of the global economic system, the US is the guarantor of freedom of the seas, the US is the guarantor of our current security situation and geopolitical situation. The US has been, throughout this period, the undisputed economic and military hegemon of the world, right? Okay. So the U.S. says this is how you're going to do stuff. This has actually been the case since the end of the Second World War, since the U.S. is the only country that's basically had a navy. If you took all the rest of the world's blue water navies and put them all together, it would still be smaller than the U.S. Navy. The U.S. has, what is it? More than 2 times the number of nuclear supercarriers in its navy than the rest of the world combined, just to give you an idea of like the actual comparative advantages that the US has over basically the rest of the world in terms of its ability to project power over the seas. So, okay, so the US dollar, US basically underpins all this. So basically everybody takes their standards for how to organize their currency, like how this all works, right? The US dollar is the world reserve currency. So everybody basically, like EU central bank is going to base how it does stuff and how it calculates inflation and all this. Also, they're going to take, a page out of the book of the US, like Thailand, where I am right now, like the Thai baht is pegged to the dollar. Like Thailand's currency is pegged to the way the US does stuff. So everybody basically who operates within the Western economic sphere, like you basically, and even people who don't, like you have to essentially base how you're going to do this off the US. Okay, so the US starts doing this, and what does this happen, right? What does this line of divergence mean in terms of the, say, like, Bush and Clinton years here? Well, basically the US government said that inflation never went above 5%. It never went above, that's what they're saying. It never went above 5% for 15 years. But what is actually true, if you use the pre-1980 metric, inflation never went below 5%, right? Inflation never went below 5% for that entire span of time. It was often 2 and 3 times the inflation rate that was declared by the Fed and the federal government. Now, during the Obama years after 2008, the degree to which the metrics were diverging stopped. So the metric, the true CPI stopped becoming even more of a lie in terms of the rate that these lines were moving apart from one another and stabilized. But they had already moved apart so much that essentially CPI is understated but constantly by a factor of 2, 3, and 4. So if you take this blue line, which is the pre-1980 standard, and you use that to calculate total inflation over the past 35 years, total inflation over the past 35 years has been in the ballpark of about 4,500%. 4,500%. Up to 2023, I think, what did I have the number at? Is like 4,390% or something like that. Okay. To give you a comparison as to why that matters, the S&P 500 over that exact same span of time has appreciated 4,410%. Okay, so the only reason why people who have invested all of their life savings over the past 35 years into the S&P 500, the only reason why they are, why this whole buy and hold in the S&P is working, and why they're doing so much better off than so many others, right, is that the S&P 500 just tracks real inflation. Okay, that's it. The S&P 500 just tracks real inflation. So if you want to know what real inflation is, just look at the historical appreciation of the S&P 500 over the past 35 years. That'll tell you just exactly what the number is. That's a real inflation. So then you might say, okay, well, why would the government lie about this? And I think, right, this is becoming very clear with what is going on right now with Doge and what Doge is trying to do. You can disagree with the methods by which the Doge committee is trying to make the government more efficient, or the degree to which this or that is a proper use of money. But the fact of the matter is the US government has been funding itself through what is often referred to as the inflation tax. Okay, so the US government has been funding these programs, has been funding its interventionary policies, has been funding things like, color revolutions in third world countries, has been doing things, right, doing this kind of NGO, these supposedly non-governmental organizations in order to spread US foreign policy and US security interests abroad. And has, also, I'm sure there's plenty of corruption, people lining their pockets in this system because it is an it is an institution that has a monopoly on what it does, so it is inherently inefficient. But right, how do you actually get the money for this? Okay, how do you do this? How do you do this, right? Like, taxes haven't gone up a bunch of times. We usually hear about, like, tax cuts for the wealthy and stuff like that. But like, how is the government actually getting the money to do this when we have this colossal foreign debt, right? Isn't this colossal foreign debt a policy? Like, why is the federal government just like constantly fine with being trillions and trillions in dollars in debt? Well, the answer is simple. Okay, if you have real inflation and you're the government, you know the real inflation data. Okay, which is what this is. When you go and sell bonds, it's free money. When you go and sell bonds, it's free money. Okay, so the government is able to give you why this is considered the risk-free rate of return on bonds is because the government knows that they are actually whoever is running the government, the US Treasury, is making more money out of this deal every time they sell a bond. As long as things don't go into default, they're making more money, right? Because they're setting the interest rate on those bonds, right? They're saying, okay, we'll give you a 20-year Treasury for 4.3%. Okay, so let's see, 20-year Treasury gets given over to let's say that 20-year Treasury, or let's for easy figures, let's say it's a 30-year Treasury, and let's say it's for even 5%, right? Now they're going to go out and they're going to offer that Treasury for 5%. And let's say household investors who are risk averse, let's say institutions, right, who want to keep their cash in a place where they can get some kind of rate on it, right? It's better than nothing. That's still true, regardless of whether the inflation is true or false. That basically what, right, they're seeing that and they're going, okay, well, look at the government, look at the real inflation, look at this red line. Inflation is never higher than 5. So if I lock in this 5% rate now, man, when inflation goes back down to the Fed's 2% target, like, I am raking it in, man. Like, okay, all right, okay. But the federal government knows that, well, actually, inflation's never been lower than 5%. So over this period of time, no matter what, every single bond that's sold is a winning bet for the government. Right, real inflation is 15%, and you're being sold a bond for 5 that you've locked in for that period of time. So it will lose its value, and then on top of that, the government is going to tax capital gains. So they definitely win, right? Every time they sell a bond, and that's how they fund this stuff. That is how the U.S. government goes ahead and funds whatever the heck it's going to do in terms of its policies, for good or for ill. This is the current system, right? This is what, and it does not matter what political party over the past 10 years. It does not matter, right? Every time a new administration has come in, basically over the past 30 years, doesn't matter. Some of this started during Reagan. it wasn't, it was kind of a marginal problem in first Bush years. Clinton got to be a problem. Bush 2, problem. Obama, problem. Biden, problem. Trump in his first term really didn't do anything about this. Interesting to see. I think he has a very different insight into what he's doing now, at least outside and what's being shown. But basically, politics hasn't mattered. Okay, it doesn't matter what political party you favored. This problem was ignored. This was just like, oh yeah, this is how it goes. Okay. So okay, why did I go on a rant and talk about this, right? This is how the whole system is set up. Okay, if you're a wage earner, if you have a job, if you're getting a 2 or a 3% or even a 5% raise per year, your salary is going down. Okay, in terms of real value, your salary is going down. Your earnings are going down. So when you hear why can't Americans afford housing, or why can't Americans afford to own a home, it's because inflation, in no uncertain terms, has been a lie and has gutted the average American's ability to afford things. And there are offshoots of this. Like, even if you're not American, if you're in any economy, which is most of the developed economies of the world, that's pegged to the U.S., you're also in the same boat. You're also in the same boat. So, basically, once you have this knowledge, right? Once you understand that no matter what you do, you're getting basically huge deflationary pressure on any of the money that you're making. It's very difficult to just sit there and take it, right? But yeah, go check it out. Go check out Shadow Stats. Yeah, very interesting. I'll have to check out Peruvian Bull on that. I liked his interview with Susan Trimbath, so I'll have to check that out. Yeah, El Mono. Yeah, definitely. I mean, a little bit is, right. So the reason why, well, number one, it seems that like it's impossible. Kind of, yeah. You don't want. You do want to have a little bit of inflation, because if you think about dollars, right? If you think about dollars, if you think about currency, as like, it's a representation of value. It's an abstraction of value to be used as a medium of exchange. So like, if your economy is growing in terms of you're producing, like you have more, your population is growing, you have more goods, you have more services, right? So like, value is mediated by your population. It's mediated by people, since people produce value. Value is something that arises from human beings. Based on human needs, human pains, human ambitions, human desires, whatever, right? It arises from human beings. And, human beings can like come up with infinite things to value, but like, we're finite beings in finite bodies. So there's only so much value we can actually like kind of engage with, to a certain extent. Like, it can still be a huge amount, but it's still kind of finite. It's bounded to a certain extent. Right. So as your population increases, right, you increase value. Like, there's only so much food that you can value. There's only so much kind of entertainment that you can value. So things like this. But as you increase your population, you do increase the total amount of kind of value that's embodied in people, that can be put out if you can sort of get people doing things. And so then you have goods and services. So then you can measure what you have, right, resources to answer that value, as to sort of correspond to that value, based on, measurements of goods and services in the economy. And then you have money, which abstractly correlates, right? So it's sort of like a potential representation, a token that maps to all of the resources that can be used to match up with human values. And there has to be a value economization thing like within human beings. But anyway, that's what money's for, right? So that you can to facilitate exchange by disembodying the value from the good or the service that answers like the human value itself. So as there are more people and there are more goods and more stuff, right? As more stuff is done by people, you might want to think about it that way. It's like human action. Like as more human action has accrued, there are more resources to which a dollar or like currency can match. So if you just keep expanding that, but you keep the currency supply the same, it can become inefficient, because then like the trades, it's like the thing like the difference between you end up with a liquidity problem. So like with trading a stock, like if you can trade a stock down to the penny, right, and you have buyers like in increments of a cent, like you'll get a lot of, like, you can average into the trade, right? You'll facilitate trades because you can map the value more precisely. Whereas like if you could only trade GME shares in like a dollar, very few people would necessarily be comfortable making those trades. It'd be harder to facilitate those trades. So you want to have your currency supply expand so that it maps to the amount of goods, services, actions, whatever value that can actually be distributed and redistributed within your society. So you do want some, and there's some evidence, right, that gold kind of has a natural, like gold makes good money because it has a natural inflation rate of about 2%. That's where we get the 2% target, because if you control like over the span of a century, that's roughly the average inflation rate of gold as it's discovered and introduced into the economy. So that's why we target 2%. So you do want to have some, but like not this much. Like Amono's saying here, it's just been a lie. It's just been a lie. They've never reached, right, except in the first, like, I need to do some research on this, but basically, like the last time the U.S. went into an inflationary crisis was to fund the Vietnam War. 1960, like basically 1965 to 1980 was this huge inflationary crisis in the US because the US government, right? You want to think about the 60s as like when you have a phase of it in the 30s and 40s, but basically like we structured our government in the 30s and 40s, partially with World War I, but we kind of demobilized it in the 20s. That's part of what made the Roaring 20s the Roaring 20s. Like U.S. was always isolationist, was always like decentralized government. Only in times of war did we like really pump up the federal government, like during the American Civil War, and then we demobilized it after like Reconstruction. And so that's what made like 1880s, 1890s, like 1900s, 1910s, like super economic growth in the U.S. Then World War I, big again to solve the World War I problem. And then like the 20s, demobilized the government again. But then there was the stock market crash, like the Fed got put into place. The Fed made stuff worse by deflating the currency too much. And then the 30s big government stuff with Franklin Delano Roosevelt were an attempt to solve that. It doesn't. From my basic understanding is none of that worked in the 30s. None of like the New Deal worked, and just like World War II solved the U.S. economy problems that just the government couldn't. Two different things, right? The Fed like screwed stuff up in the 30s, and then the government. The federal government didn't make stuff better with all these like federal work programs in the 30s. So it was like kind of a 1-2 punch. It's like the Fed screwed it up in like 1931, and then the federal government just like kept it not improving as fast as it could in the 30s, and then World War II fixed that. in the sense that like, oh my gosh, we have to go fight the Nazis in Japan military industrial complex, which was Eisenhower's warning in the 50s, was like, watch out that they're going to do this because the government doesn't know how, like, really, right? The government does not know, the federal government, the executive branch, whatever, does not know how to get America, does not know how to get its country. It's not even true for just America, doesn't know how to solve an economic crisis except with war. That's also what's in 1984, right? They don't know how to make the economy work except with war, because what's the government for? Why do you need the government? Because sometimes war happens. And that executive centralized organization of things, just in the same way that in our brain, like our brain operates that way when we need to defend ourselves, that's what that's for, right? You don't need really the government to do domestic shit. Like people can figure that out, but people can't like organize militarily without that, dictatorial kind of organization. That's the problem with authoritarian governments, right? They get into power, they do that to solve a crisis, but then they want to hold on to that. And so everything enters into a perma crisis. This is why like communist states are permanently militarized. They're permanently militarized against a fascist capitalist enemy that wants to destroy them at all times. Just like look at Albania. Like who cared about Albania? But like Enver Hoxha, dictator of Albania, was just like convinced that America was plotting constantly to undo the revolution. Albania, because it's Albania. But anyway, peace to all my Arbrechte out there. But lovely country. Yeah, so New Deal stuff into the 60s, right? Then basically Eisenhower warned about this at the end of the 50s. And then in the 60s, what did we get? U.S. concerns, panic about the USSR needing to use these interventionary measures in third world countries to be able to, fight domino theory stuff and intervene, like send advisors to Vietnam. So this policy, right, to like put in the inflation tax was what the federal government started doing in the 1960s to fund American interventionism in Vietnam. And every phase of escalation was funded with inflation. And then you got the draft and things like that, right? But that was what this was for. So what you ended up in the 70s, this was blamed on like the oil embargo. This was blamed on what what was going on with like OPEC, or like it was blamed on just kind of depression, like what was it, the hangover of the 1960s or something like that, like hippies and something, or drugs and all that. I'm not right. Maybe that played a role, but like there was hyperinflation, and then the U.S. government tried to do things like price controls that created. Thomas Sowell is great on this, talking about like the gas shortage in the 1970s. Like the thing that created all the gas problems in the 1970s wasn't the OPEC oil embargo. Like this didn't, like the U.S. was fine in terms of having access to petroleum, but they put prices, like it caused the price to go up a bit. And then the current administration, I think it was either Ford or Carter, I'm not exactly sure, put gas price controls. So then basically what happened is you encourage, just like, like the sort of like the toilet paper behavior during COVID, which was weird. You encourage gas hoarding. So like everybody, because they weren't sure if there was going to be gas in the pumps, right? Because people were pumping gas as though it were as available in the international, like there was a supply that matched the previous price that was uncontrolled, but that was a lie. And so people, gas stations started running out of gas. So then that caused the panic. So then people started basically making sure that their tanks were full all the time. Everybody was just like traveling around with gas in their tanks, or just having gas sit in their cars, because they didn't know, they were unsure if they could stop and get gas at any point, or if they would have to wait in like a 3 or 4 hour line. So like a lot of those problems were, again, like issues with price controls. But the government attempted to solve this, again, by continuing to inflate the currency, to solve problems, to redeploy resources and fund programs around the world. Right in the 70s, late 70s, right? Then they started funding the Mujahideen in like Afghanistan and all that. So Right. So it wasn't until 1980. It was like what Volcker, head of the Fed, teamed up, or 1981, right? Volcker and Reagan started to be like, okay, we have to solve the inflation issue, and they like listened to Milton Friedman, and then Milton Friedman had basically said, look, if you get into one of these issues, the only way that you get yourself out of the runaway inflation loop is you have to jack up the federal interest rate. You have to jack up the federal interest rate. And the government wouldn't do this because it does make some people who like took bad mortgages, it makes them default on their mortgages, which doesn't look good politically, right? If you adopt a policy as president that makes people default on their homes, even though they're defaulting on their homes because their mortgage rates were bad, like they took bad deals, that still reflects badly on you as a politician in the moment. So Reagan decided to like Reagan and Volcker talked about this after he was elected, but before he came into office. And they're like, just do it. Just do it. It's going to be like a year. It's going to be like a year and a half or something like that. It's going to suck. We're going to jack up interest rates to like 20%. There will be some people who default on their homes, but it will kill inflation because people will see the bond rate and then just save all their money, just put all their money into bonds. And it'll stop. And of course, stop fucking printing money. Yeah, so you can see that, right? That's what happened here with this declining rate here. This is the only time, right, in the past 35 years, this is the only time, 1987 is the actual only time that the Fed ever actually got inflation down to 2%. One time in 1987. That's it. Everything else has been a lie. Everything else has been a lie. Of course, this is how I see stuff for the moment. If this is indeed true, it seems to hold up for me. It seems to make sense, and it seems to make sense right very recently with some of this hyperinflation, basically since 2021. That that this is lived experience says this is of course is happening. This is when I started noticing this, like in my life, my lived experience. So that's kind of what figuring this out, like learning this, trying to understand what was happening. Like this is what drove me to try to start doing this and like offering this, content and trying to figure out like what's going on with investment and trading and stuff like that. So yeah, and you see this drain too. People talk about like I've heard Musk talk about this before, but I noticed this too. Like I did my PhD at Yale, and like had friends that studied at like I did my undergrad Johns Hopkins. Like I knew people, friends down at like who went to Duke, or like friends of their friends who were at similar schools, and you just have like in Ivy League schools, like Ivy League or like whatever these are, these upper tier like universities, you have a huge amount of people who go into finance and consulting. And like I know so many people who did that. And part of the reason that they do that is like they come from families who know that this is actually how it works. And so unless you can learn, unless you have access to the learning sources, to the channels that actually can teach you this stuff, and you can get hands-on experience with this, it's like every other thing that you go into, maybe besides being an entrepreneur, but there's way more risk with that, is over time you're losing, right? Every year you are willingly accepting that the amount of money that someone pays you to do something will go down. You will be compensated less every year for your labor. You will be compensated every year less for your output. Maybe sales is another exception to that. Or something that's kind of like your wage rate and stuff is really heavily determined by like the market price of things. But that's why so many people do that, because they understand that this is what has happened over the past few years to the U.S., right? people who, flock to these kind of managerial positions, either in government or in business or something like that, because they just kind of chase whatever looks like a good salary now, and eventually that'll run out. That won't work for them in another 5 or 10 years. But if they can, another way around that is you get a solid amount of money kind of early on, and then you can put it into the market. So then as inflation goes on, you can do something to fight that. But yeah, that's the reality there. And then of course, you have all this talent, all these capable people who could be doing things like inventing technologies or working on cancer or working on like senescence, right? They're like, why is not everybody like working on senescence? Like everybody should be a biologist who can be, and go like work with David Sinclair up at like that Harvard lab on senescence. Like if we can solve senescence, it means you basically get to be like 30 until you're 100. Like why wouldn't you want that? That's awesome. But instead, people are like, well, I don't want to have no way to raise a family or have any money at all to like feed myself or help my kids like have a good life. So I guess I'll just try to understand. I'll spend all this time trying to understand this financial system we have. So anyway, that was a big rant. Didn't necessarily intend to talk about that, but that's how it goes. So shouldn't exchanges create value instead of devalue currency? Exchanges can't create value. You can't create value by exchanging it, right? Like you can't move a 0 from a 1 by just moving it from here to there, right? You can invest value in it by moving it. Like if you're a merchant or something like that, because you can make it more convenient to certain people. But the origin of value is human beings. You can't create value by changing things. You can only create new value by helping human beings expand their value, either by creating more human beings or by, I don't know, I guess educating human beings to see value. Um, I guess to discover value through exploration. That's really it, right? Make more human beings and then allow human beings to explore and discover value. That's kind of it. Anyway, I'm glad you did. I'm glad you did. We will get to some GameStop stuff, but you know, yeah, I've come to understand this stuff, and I just want more people to understand this, right? Like not necessarily telling people like, get upset, revolution, give up your lives, but it's like, you know, this is what's going on to all of us. This is what the powers that be for the past several decades. Like this is the world that we've been born into, and even to be able to do something to stop this, right? Because things feel wrong. It feels like it shouldn't be like this. So even if we can do something like this, even if we like kind of have a basic idea, right, of hey, this is what's going on, then we can start to try strategies to rectify the problem, right? Knowing that the basic shape of the problem at least allows us to start coming up with solutions. So that's a good question, Chuck. Let's get into this. Let's get into some GameStop stuff today. Now after this little inflation and macroeconomic rant here, with a little history for you. So yeah, so this is a combination of things. So this is a combination of on the one hand, the way that using their tools to control the price. Part of it is just kind of the organic behavior of the options market. Another part of this is, yeah, what I started to talk about in my video earlier today, in my what I mentioned in my write up for Friday's trading day, and what we actually talked about, right? Those of you who are around on the live stream on the 17th, if you want to go back and rewatch the 17th live stream, we talked about volatility cycles. So we'll break down that. Let's start small. So let's start with the price action stuff. Chuck's got a good question here. So let's hop on over to, let's go over to Thinkorswim. Okay. So let's make this a little bigger here. Okay, there you. All right. So first question, why does this thing slip down to 27? Okay. So you'll see right on a day like this. Okay. Let me hide this. The short answer is charm. So charm is, we can alternatively express charm as delta decay over time. So a lot of this has to do with the options market. Okay, so part of understanding what drives most day-to-day price action, like what actually makes most of this stuff happen, is market maker hedging. So market makers, right? The idea of a market maker makes the market. Okay, yeah, a little sophistic there, right? Circular logic, but circular definition, I should say. But a market maker actually has a fiduciary responsibility in their role as market maker to provide liquidity to the whatever their particular area is, right? So GameStop has a couple market makers. GameStop has a designated equities market maker. That is Citadel Securities, right? Citadel is GameStop's designated market maker for equities. So Citadel provides quotes on the share price, which means that there doesn't necessarily need to be a buyer, but Citadel has an algorithmic pricing model that determines, what based on the current context and what's going on, a sort of fair price to offer both as a bid and sell. And so what people come in and do is, people will come in and, put in an order. And if there is no, the idea is like, if there is no other trader there, if there isn't like an actual, like the auction system bid ask, if there isn't a trader who has a trade put up at that price and it's relatively close to what or at what Citadel as equities market maker assesses is the a fair market price at this particular moment in time, then Citadel will go ahead and just complete the trade as a trade partner. They will go ahead and they will buy that share, right? So that's how a quote system works. The market maker puts up has a certain amount of liquidity that they can offer to facilitate these trades so that trades can happen. And then over time, based on their particular trading and hedging and market making strategies, they make sure that they can do this at a profit to themselves while providing this service. And sort of their ability to profit is their reward, let's say, from the system, their fair compensation from the system for enabling buyers to come in and basically, participate to execute trades whenever they'd like. GameStop also has an options market maker. Okay, so the options market maker is Wolverine Trading. Wolverine does exactly that same thing, but with the options market. So whenever, let's hop over to the options tab here. So right, if you see all these contracts, right, you see all of these bids and asks. Okay, with some of these, if they're low liquidity, like they may be actual like bids and asks from buyers, but most of these are not actual bids and asks from buyers themselves. These are quotes by Wolverine Trading. And so Wolverine Trading just puts these up on every strike. Right? Wolverine Trading says, okay, this strike exists. Oh, actually, it would be, I guess, like to a certain extent, the broker. Like they sort of negotiate, I guess, with the brokers and say, like, this strike exists. Right now, we're buying for this and selling for this. And then if you put in your order, they'll go, let's say you put something in the middle, they'll go, oh, okay, right? And they'll keep a wide bid-ask spread so that inexperienced people will buy things at like way under or sell them for way under their value or buy them for way over their value, and then they make money off the spread. Or if you put in the mid, if it still works within their model, they'll go, okay, we'll take that trade, right? We'll go ahead and do that. So how can they do this? How can they just like take whatever trade there is and not go broke? Like how can they do this? How can they not blow up? Part of the way they do this is hedging. So you guys will hear me talk about gamma hedging, especially a lot. Sometimes I'll talk about delta hedging. But right, basically what they do, everything is based off of the delta of these contracts. So they have a dynamic way of making sure that no matter which way the trade goes, they're not losing, right? They're neutral on the trade. And they want to remain perfectly neutral on the trade dynamically at all times so that they just make money on the volume of trades that come in because they collect a little commission and they also collect premium, especially with short contracts, right? They collect premium based on that. And the idea is, in general, they do this because retail trading behavior is primarily long, right? Retail trades across equities, across indices is primarily single leg and long. On something like SPY, it's going to be calls and puts. On GameStop, it is overwhelmingly long calls. So they end up being dealers, broker dealers, market makers. They end up being primarily on the short side, and so they collect premium off of this stuff. They profit off of their premium, and they profit off of commissions and fees for executing these trades. Okay, so it's just a question of volume for them. The more trades that they facilitate, the more money they make. Okay, so with their hedging practice involves hedging around an options contract's delta. So delta, which is very commonly a Greek in mathematics, right, is very commonly a Greek letter which is used to represent change. Delta represents the appreciation. It tracks the appreciation in the value of an options contract per dollar movement in the underlying. So if you have let's say a contract that has a delta value of 57, if the underlying share, which that options contract maps to, let's say a GameStop share, increases by $1, then the options contract will increase by 57 cents per share that it maps to. So your options contract, which maps to 100 shares, will go up by $57 for every dollar that the underlying share does. So if you want to hedge that value, what you would do is you say, okay, if it goes up $1, it'll go up. Okay, it'll go up $57. So what do we do? Well, if we are short this contract, right? So we have negative delta, which means that our position will decrease by $57 if it goes up $1. Then we will go ahead and as we're holding this short with negative deltas, the short call, we will buy shares to hedge the negative delta. So those shares will go buy 57 shares. So we have positive 57 delta on our books from those shares. At the same time that contract has negative 57 delta on our books from being short with our counterparty, in this case, the trader who is long the contract. So then that negative 57 delta from the call and the positive 57 delta from the shares will cancel out. Okay. But delta does not stay the same if the price goes up $1, right? If the price goes up $1, the delta value will change. The delta value will now, as the price, say, it's getting more and more in the money, the delta will continue to appreciate until it gets to 1. So the market maker will have to purchase more shares to hedge the change in delta. And there are then what you would have the second order derivatives of options contracts. So gamma's big, Vanna, Charm will come into play as they attempt to make sense they attempt to model how much the delta will change based on the change in the underlying. So gamma is hedging the rate of change of delta. So the rate of change of the rate of change with respect to the underlying. Vanna measures the change in delta per increase in vega. So vega is not a real Greek letter, neither is vana, but vega corresponds to IV. So as the implied volatility goes up, the delta will also change on the contract. So vana maps that. They will also vana hedge. And then charm. Charm is the rate of change of delta with respect to time. So how much the delta increases or decreases based on the time depreciation of the options contract. So theta is the Greek letter that maps the time value. So what you will see is that over time, right, out of the money contracts are going to depreciate in value based on their charm. So as that occurs, and it's going to occur most sharply heading into the end of the trading day here. So right, you'll get this kind of steep slump sell-off that is based on the fact that as market makers have a lot of short calls on their books, especially out of the money short calls, the value of those contracts, the delta value of those contracts is going to decay. And they will go ahead and say, okay, so let's say, right, they have all of this. Let's see, I did it with my left hand. Okay, so let's say here, right? Let's say here we have all these short calls. Let's say there are 10,000 short calls, and at the beginning of the day, they have a delta value of 0.1. Okay, so multiply that by 10. That means that, let's just, in this ideal hypothetical case, they're holding 100,000 shares to hedge that delta. But over the course of this day, if that contract remains out of the money, let's say it's the $28 contract, right? By the end of the day, it's going to be zero if it closes out of the money. So over the course of the day, they will slowly sell those 100,000 shares so that, because they don't need them anymore, right? They don't need to deliver them. They don't need to hedge that position because it's going to close out of the money. As the probability ticks down, charm takes delta out with it, and they hedge those shares. Well, I'll tell you, at the beginning of the day, there were, just for this week, 10,000 contracts open, close to 10,000 contracts open at $28. And the delta value was not 0.1, it was like 0.5, maybe a little higher even, when we were trading up above, because, right, the 28s were in the money at that point. So at the beginning of the day, they were holding something like 500,000 shares as hedges for those $28 contracts. Then as the price slips below and time goes on, they are able to sell those 500,000 shares that they were holding at the beginning of the day. So unless somebody comes in and like knocks that contract back into the money, then they can go ahead and sell those shares. And what is that going to do? It's going to put this kind of steady, low-grade sell pressure all throughout the day on the stock until it continues to slip down, 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 down. Now, they can do things in order to make sure that they can guarantee that they can have this sell pressure throughout the entire day. So, for example, this here was probably this immediate movement we saw. This was probably some heavy shorting. Okay, this was some heavy shorting right at the beginning of the day that knocked this under $28, and also allowed traders, right, because a bunch of traders had entered into long calls throughout the week. All of a sudden, we open up here, and they go, oh my gosh, my options are up. What's going to happen? And as soon as we get that first big red candle, what do all these people holding long calls do? They try to leap out of these as fast as they can. And of course, there's the options maker says, okay, I'll take them back. Options market, buy, 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 buy. Take them back, take them back, take them back, take them back. And, oh, well, now we have all these on our books. So, you know, let's just if they're not closed, right? Okay, we'll just let this run back. Let it run back while we close our, because we know we're going to close our short. That's what this was, right? Look for V-shaped recovery. V-shaped recoveries tell you when an institution is closing a short position. That sharp move like that, where we have lots of kind of solidly green candles back to back to back to back, and then we go directly to something like VWAP. We just went above VWAP and dumped, and then up to these moving averages. That should give you a hint. So that's what this was. Okay. So then they bought this back. So this is traders panicking and shorting happening, and then buy back, and then okay, then they're pretty confident. Cool. We'll just let this bleed off into the rest of the day. Charm can happen, right? And there was basically nothing else at this point that would compel the price to keep doing stuff. Maybe I think probably even here they probably did some shorting to make sure it would come down, right? These types of movements where you see volume spike after these pretty sharp rundowns, there's probably some shorting in there. And so when I talk about tactical shorting, this is the type of stuff that I mean. That's not a lot of volume, right? You do not need a lot of shares in order to get this result. You don't need to short a lot in order to get this result. This stuff can be achieved, this and this can be achieved with like 100,000 shares. Don't need to do that much. And then the reason why you can do that and have confidence that it'll take you to where you want to go at the end of the day is because you know your own hedging model. You know that you're going to keep putting on this general, right? And so then the 28s come out of the money. You're already cutting those because of charm. Now the 2750s are out of the money, and now you can cut all the hedging for that. And the 27s, okay, right? Those are getting closer to being in the money, but you have all this stuff stacked on top of it too, that maybe it gets down to like 5 delta or 3 delta or something like that, and you can hedge those. So you just keep this downward pressure. But right at the same time, you do have positive charm from what's in the money. And so then right, like you designed your own algorithm to do this. You designed your own model to hedge this stuff. You basically know you can calculate from the charm values in your own model, like where the equilibrium point is. And so, yeah, 27. So like, I don't actually go like by hand and calculate all this stuff out. But like, if you watch this happen enough times, you can be like, oh, okay, well, we got up here. This, like, okay, max pain was here. We were trading above this yesterday. It's probably going to 27 if we do this. And I said this. I was talking to a few people who were, they're taking some bets. They're like, I think it closes at this. I think it closes at this. And I was like, okay, if we get above this price, we'll close here. If we don't, then we close here, right? So if we trade above 28 and we go test that 29 thing, I was like, probably close at like 27.90 something, right? But if we don't and we just go a little bit above 28 and then dip under and then we're under 28 the whole day, we close at 27. Something like that. So you can kind of eyeball it. I just kind of use intuition, stuff like that. But is that clear? That was a great question, by the way, Chuck. That's how they do that, man. That's how they do that. That's why also too, right? So many, covered call, a call wall target covered call going into the end of the week is such a high probability trade, because if you know that this dynamic, right? With this dynamic, you have certain knowledge, and that alters the probability of success. It doesn't work 100% of the time, but like, so if you get that spike up there, right? Call well covered call is a safe one. And then just watch that die, right? Happens so many times. Yeah. Okay. So I also wanted to make sure we got to the volatility cycle thing. I see some good questions I want to come back to. Short Friday, this is a good question. I definitely want to come back to this. Oh yeah. Oh yeah. Okay. So, right, what we also need to understand at this point is mainstream media, legacy media, no matter what, is somebody's propaganda arm at this point. Okay? No matter what, the reason why this is, okay, is because all journalists have been trained in universities that give them postmodern ethics, postmodern ideas about what it means to convey information. And the postmodern framing of what it means to convey information is to position oneself as the framer of a narrative that gives one control over power dynamics. Okay? Because in the postmodern world, everything is power. Everything is about power dynamics. That's number one. And number two, power is in framing the narrative. Whoever has control of language, whoever has control of the narrative, because we all live in a story. A story is how human beings bring together all of our perceptive faculties and then integrate our environment around us. Stories are a verbal constitution of an affectively motivated, behavioral, embodied framework that's usually packaged in an image. Okay? So postmodernists believe that that's actually the fundamental reality, right? This is sort of a development out of Kant. The idea that the Ding an sich, as Kant calls it, is not actually reachable. It can't be reached. We can't know what's out there. The thing in itself, Ding an sich, is not knowable. But it's absolutely not knowable, right? The postmodernists, I don't know to the extent to which Kant actually, he's like convicted of the idea that it's like absolutely not knowable. He knows it's absolutely not knowable in the sense that you'll never get to 100%. That's a fair epistemology. I haven't read his specific epistemology close enough to be able to tell if he believes it's like partially knowable. But postmodernists don't think that knowledge, right? So like Foucault, etc., don't think that knowledge of the thing out there is possible. Maybe even Foucault actually does believe that, but that's not what he devoted his life to, and that's not what he writes about. That things in and of themselves are not knowable. And so it's all about how knowledge is constructed. And because knowledge is something that is always constructed, like by a mechanical apparatus in the human mind, that the narrative is that constructing apparatus. He that has control of language can use language as a tool to construct a narrative, and then the narrative as it is constructed by the narrator and the wielder of language is then able to control reality. That is at the foundation of postmodern philosophy. Every journalist in the past 50 years, certainly most of them in the past 50 years, but certainly the past 30 years, schools of journalism, this is what they are taught. And so what we have is we now have the fruits of a series of media institutions where those who actually publish and work for these institutions have been trained with postmodern philosophy, have been trained on postmodern ethics, and investigative journalists no longer operate like scientists because that's what they were, right? That's what it meant to be a journalist. A journalist was like a scientist. Go out there in the world, explore, get your sources, right? No, there's not really a difference, but a journalist is looking at events on the ground and reporting them live as they happen. Okay? Now, journalists are looking at events on the ground live as they happen and then saying, how can I fit this to the narratives that my organization is paying me to continue to build and enforce and instruct? And now, what's really interesting too, right, about the Doge stuff is now we understand to what extent different departments of the federal government have been directly paying major international news organizations in order to push these narratives, in order to do this stuff, to construct these narratives and go ahead with these types of operations. So what with So with CNBC, with financial journals, it's not different, right? But they're just in the pay of they're just in the pay of Wall Street and politicians and whatnot, or I don't know, certain corrupt corporate elements who are kind of have a dark deal thing going on. They're like, push this. So that's it. They don't want people to learn this. Like I posted today. Somebody, why does someone like why do I keep getting targeted? Like, why do people try to like take out my accounts and stuff like this? And I said it's because, like, look, I'm not like okay. Number one, talking about this, having an audience to talk about this, like, and like getting your questions and stuff and being able to talk to you guys, like, does help me figure stuff out. Like, I do learn things and I do get inspiration to go and investigate things and study things based on like being able to talk to you guys. So like, number one, I understand that the only way that my understanding grows and that I can continue to develop in this is if I continue to talk and help and interact with other people. Right, Richard Feynman, great point on that. Right, the number one way to learn is to teach. If you take on voluntary responsibility for helping other people understand something, you'll treat your own increase in understanding with greater respect. You will begin to treat the growth of your understanding the way you would with the responsibility that you give to other people. So that's number one. So you guys definitely helped me in that. Is number one. But number two, like, yeah, I was literally never interested in finance. I was never interested in finance until I had to be. I wanted to teach and talk about history and do all that. Like, that's what I wanted to do. And because of what people in finance and government and media and all this dark deal, and intellectuals are a part of this too. Intellectuals are absolutely a part of this because they've been giving legitimacy to these practices for if you haven't noticed, every single Ivy League university is a secret nonprofit hedge fund, right? Look at Yale and Harvard now have like endowment. I watched Yale's endowment go from like $8 billion to $50 billion in while I was a graduate student. I watched them in 2001 have a year-over-year return, or 2021, 2022. I watched them have over a 44% annual return on their endowment, which was already like 30-something billion. They made like $9 billion in a year because what do? They have people in the financial elite who understand this stuff. Now, I'm not necessarily saying that I don't have evidence to say, oh, all the people running Yale's endowment are pieces of shit, like some of these Wall Street guys that we know otherwise. No, not necessarily. I don't, but they understand how this works, right? They understand this. I wouldn't be surprised if some of them were, but I'm not about to go torch and pitchforks and be like, rah, Yale, I wanted to be a history teacher, why didn't you help me? No, that's not what I'm saying. That's not what I'm saying. That's not what I'm doing. But right, these organizations have basically accepted that this is the way that things go. And there are definitely plenty of professors and administrators and whoever at Yale who just, they want to be in Washington, but they want to, whatever. They want to weigh in on political stuff and geopolitics and get their little interviews on MSNBC and whatever, and talk about that stuff and yet continue to collect their their nice tenured salaries, whatever, and be consulted as experts and whatnot without risking anything. But yeah, right. So why do I do this? Why am I targeted? Right? Because like I just want, I want other people to understand this stuff. Because if like I would be happy if it changed to a way that would mean that we all don't have to bother with this stuff, that we can all go and do the things, the exploratory and creative passions that like all of us would rather do, and be able to make money of that, not worrying about like, oh my gosh, every year am I just going to get defrauded by a financial infrastructure, / government collusion / media propaganda machine that is stealing all my money, like slowly making me and my family and future generations poor every year, right? with inflation and stock manipulation and shit. So yeah. Yeah, yeah, that's the 21st century Renaissance idea, man, right? Universities, institutions, schooling, like stuff like this had gotten to a pretty low state in late medieval Europe. Um, and, you know, in part, the Renaissance was about kind of going outside of established information circles, the kind of over regulation, the over kind of legalization of, universities and schools and things like this, and going and exploring other things outside of that, and sort of what the consequences were that for what developed in European history. So, like I said, sometimes we'll have to have a video or a stream or sometime where we can like talk about the Renaissance and stuff, because I'll go on for a while. But yeah, that's the idea, right? This is an alternate communicative channel. What we're doing here on YouTube, what we're doing on Twitter, what everybody's doing here, right? It's decentralizing all this stuff, decentralizing journalism, decentralizing a lot of academic research, decentralizing, all these types of services and education and all that, the free exchange of information, decentralizing all of this, because the previous systems have become so decrepit, have become so controlled, corrupt, colluding with each other, that this is the only way that we can do this, right? Like, could you imagine, like, if you like in high school, like just like your last year, they're like, okay, everybody, now it's time to learn about finance, because this controls everything that you will do for the rest of your life. Let's talk about the basics of inflation. Forget the lie numbers, right? What if they even just taught us about how inflation worked for, like, as the government declared that it worked? But no. In any case, there's always a balance, right? Depending on the situation. In some situations, usually they're crisis situations, centralization is a necessary way to preserve the whole, defend the individual, things like that, right? But in most situations, really most of the time, it's decentralization. Decentralization, localization of decision making and information to the peripheries, to, like, localities, right? Think about it this way. Would you rather live as you do, or would you rather have, like, controlling the rate of your heart be an executive function that you had to think about consciously all hours and minutes of the day? Right? That helps illustrate the principle pretty well. Would you like to consciously have to think about breathing every day, or would you rather that just be automatically regulated by something that your consciousness does not have to think about? Right? Would you rather, do you want to perform a checksum? Like, would you rather executively, consciously have to go through, like, all of your cells and, like, tell all of them, like, the rate at which they need to be taking in energy, so that, like, their nutrients, so that their mitochondria produce enough energy at the cellular level? Or would you rather that be all just, like, local decisions for your cells to make, that just, like, they have that information, like, somewhere, in the nucleus, and they just, like, kind of make that simple local decision or something, right? Yeah, like, it's ridiculous that you would even think that way, but we do have people in government who say, like, we should be telling people this or that, like, in their like local schools or something, but, like, not telling them the actual, like, executive function stuff they need to run their life. In any case, so then the other element I want to talk about today was our volatility cycles. So, right, talked about this, that we're coming to a close here for one of these. Let me see if I can bring this up. Let me point this out to you guys. Yeah, here it is. Oh, 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 that's weird. My screen's doing weird stuff now. Of one. Okay, so here's what this looks like. Okay, we're up, we're moving. Volatility is high, right? What it seems to be the case is around the 9th on this market closure, they were able to create a bunch of short liquidity because there were not a lot of shares available in here. Ken commented on this on my last video. He went ahead and checked this for me. It was the lowest that I had seen when we were at the top here. And I even talked about this. I was like, dang, GME is in a heck of a liquidity crunch right now. And basically what I was looking at in that week is this was my whole thing basically through kind of October, November, into December, that, hey, if we keep seeing these benchmarks, it's going to be right around, I think I said this, it's like around January 15th. This is going to be our key date. I said this on multiple videos. January 15th, we need to see something from Roaring Kitty or Cohen or something like that around January 15th, a couple days before options expiry. That's the perfect moment for it. If it happens, it's going to blow up the options chain. We're going to go nuts to the upside, but we need something. We need something like that. Otherwise, we're not going to. We're not really going to take off. We need that type of event. We didn't get that type of event, right? We didn't get something. The January 9th weirdness probably allowed these institutions to be able to, package or deal, settle some weird stuff with FTDs. They had, this day to figure out how this was going to work. Package this, kick this down the road. They came in over here, right? They came in over here, huge short volume with all through here, right? I noticed really quickly shares available to borrow started spiking up. Here they were like 100,000, and then by the time we got to like here, they were back over like 1.5 million, like 1.6 million. And I was like, well, the 15th here, I was off by a day for my own side, right? I missed this too, right? I was not able to profit off of the down move on the 14th. I was like, if we don't see something on the 15th, I was like, I'm gonna probably reposition, because I think, after OPEX, when that goes down, we're not going to have support at 30 anymore. But they came in early, used this synthetic liquidity that they created, shorted the stock super hard, killed IV with it. Oh, there were so many options contracts in here. They did this before OPEX. Started killing this, right? Allow IV to continue to bleed, short it once more. Bleed. Like within a couple percentage points of 52-week lows here. And then here comes the up move. Okay, right? So now in here, right, we saw XRT come off reg show. So we know that they were closing these older FTDs. Otherwise, category 42 makes a great, why did we shoot all the way back up here? Oh, well, that just happens to be right about where we fell off from, right? So this move was, tracking basically all of the volume that they, as otherwise would call this, boofed, but all of the shares that they FTD'd, all the stuff that they didn't buy, all the positions that they didn't close with buying. They now here came and then had to buy these, take these all the way back up. IV goes with it. Okay, in it comes. We might continue to trade up a bit for a couple days. I think I talked about this in my video, in my article. We might continue to trade up for a couple days. But basically, this is what this pattern looks like, and we have a ton of time left before we get to March earnings. That I significantly think, I pointed this out, right? I don't know. Maybe we kind of trace back to the upside a little bit, kind of slowly here. Maybe we do. Maybe it looks something like that. I'll have to see how this develops out on our charts. Maybe we kind of resume in a kind of upward listing pattern, something like this. We'll have to see how we behave basically next week into Feb OPEX, and then maybe out of that. But we have enough time to basically do another one if we wanted to do another one. So I'd really recommend go check out our discussion from the 17th if you want to refresh yourself on what the beginning of that cycle looked like. But I think we do have some serious possibility to do that again. And if we can, certainly I take this into consideration for my own trading strategies for how I try to understand and anticipate this type of price movement. I think we might get a kind of small correction, maybe back down to the 200-day moving average there, that blue line at the bottom, before maybe we start to move back up again. But yeah, but that's what I see us in the midst of here. I would really recommend you go check out Girk's DD, When the River Runs Dry. Highly recommend. And yeah, to get some good insight into how we could enter into another one of these cycles. So keeping an eye on this as we head into February OPEX. But yeah. Yeah. Well, easy to get cynical about it. Let's see. Let me come back to this question from Short Fridays. Right, RC buys 4 billion of Bitcoin. It runs to $60. He dilutes at that point. Stock goes down to 30 again. But now they have Bitcoin and 4 billion again in cash. Thoughts? Would he put it into Bitcoin? I mean, what's his name? Foxen. What's this guy's name? What's his actual term? Foxen Flask. Foxen Flask actually has a good point on this, that Cohen himself may already be invested in MicroStrategy. It's possible that he's already invested in MicroStrategy, but that would be maybe for himself. And then maybe he would have made money off of this himself, and he's going to use that capital to maybe force an up move in GameStop, right? That this might have to do with why he's moved his GameStop shares out of RC Ventures. Like maybe he's holding shares of MicroStrategy in RC Ventures, and he's got his GameStop shares in his name. And so this way, I don't know if there's a way that he can accrue GameStop shares in secret, or cash in secret or something through RC Ventures. I'm not sure. Under the 5% holding deadline, he might be doing something like that. He might already have done something like that. There was some talk earlier too that like Cohen might have held a substantial amount of his original Chewy holdings, right? When he left Chewy, like he had an exit, but part of that exit may have entailed that he got to keep a sizable portion of the company. So it's possible that Cohen, may have had that kind of Chewy value, and Cohen maybe took profits on some of that off of this recent run or something. Might use the money to do something with GameStop. I'm not sure. But as far as like the actual Bitcoin stuff, all that we really know is that he took a picture with Michael Saylor. That's it. I would say, right, looking at kind of the Bitcoin charts, well, kind of maybe this is something to bring up over a couple live streams to come, but I am kind of, I think probably will, again, right, heading into the end of February, stuff still looks pretty good for the general market. I think we could really see like a definitive, another all-time high over the next couple weeks in February, but stuff heading into March is not as optimistic as I talked about at the beginning of Friday's video. So we might be in for a correction in March. Some of the longer term stuff, not necessarily looking awesome in the broader market. So it is possible that we get some weakness kind of developing into maybe the summer. This does kind of line up with a sort of bigger correction cycle type theory thing. And I'm interested. I'm not sure what that would mean for Bitcoin. So I have to do some more analytics there to like sort of get an idea of what happens if we get a crazy market correction. Like, does Bitcoin dump with it, because is like Bitcoin now like wrapped up in so many like Wall Street ETFs or something that like now it's going to get would that tank or something like that? So, I don't look into the cryptocurrency market that much, but worth considering. So I'm not sure that would be that might be a Ryan Cohen strategy. I'm not sure if that's an actual GameStop strategy, if you know what I mean. Yeah. I don't know what this question means. What GME price do you make white? I don't know what that means. Yeah, yeah, I'm with Guido here. I think, yeah, they're kind of some enigmata. They're interesting folks. But yeah, they stay unpredictable, right? We'll know once they've unveiled it. But hopefully, I think Roaring Kitty's going to do his continual type of thing, continue to generate money by trading like awesomely. Not sure. I mean, probably Cohen's strategy is to kind of pull off some kind of like investment or trading related thing. Like he is going to shore up GameStop and is going to work on like they're doing all this tech hiring. So I do like the idea of the PSA like NFT tokenized market like synchronous deal. That's pretty cool. I hope that works. But we'll have to see. And then yeah, sexy explosion. Indeed. Indeed. Yeah. It might. Not sure. I know the console cycle thing is a pretty big bullish factor, right? That was a big element in 2020, right? Like Christmas 2020 was the release of PS5. I'm not kept up with my cycles, but this is kind of going into one, right? We have Switch 2 coming out this year. Grand Theft Auto 6 could be big. Could be big. We will have to see what that means for company fundamentals and such. So yeah, so that's where I think we are. I hope all of this was helpful to you guys. I know right, we started off there getting into some inflation stuff and context and economic history and whatnot, and but just so I think it's helpful, right? Just so you know, like kind of the page that I'm on and why I'm looking at this the way that I am and why I approach this the way that I do and how I'm thinking about this and where this all fits in and you know why also why I'm not interested in like being a like join my premium Discord furu or anything like that. So just want to give a big thanks to you guys for continuing to be a part of this and for helping me continue to grow and understand and ask questions and something like that. Continuing to help me get better, which I appreciate. Which is the greatest the greatest gift that I could ask for. Right, to have the adventure of a lifetime toward becoming someone excellent for other people. So thanks very much, you guys. Yeah, shoot me questions. You have questions, you have comments, you just want to kind of point something out, post a meme, whatever you like, right? On X, keep or right here on YouTube. Keep it coming, guys. So yeah, so thanks very much. We'll catch you guys on Tuesday, right? Market closure on Monday. So we'll see you guys on Tuesday. Have a great President's Day weekend. Thank you very much, guys. And yeah, we'll catch you soon. Take care.